Now, publicly available information includes federal, state, or local government records. So, for example, one could discover that I had a mortgage through SunTrust Bank, and that would be public information. Even if someone needed a password or fee for access, it would be public information. However, the loan balance on my mortgage loan with SunTrust Bank would be non-public personal information. Now that we understand better what is considered to be non-public personal information, let's understand what the Gramm-Leach-Bliley Act says about how we disclose this information. Well, the Gramm-Leach-Bliley Act Financial Privacy Rule regulates the collection of non-public personal information and restricts when the information may be disclosed to affiliates and non-affiliate third parties. It also prohibits the disclosure of access codes and account numbers to non-affiliated third parties while also requiring a consumer privacy notice. The Gramm-Leach-Bliley Act also has a pretexting rule which protects consumers from people and companies who obtain personal financial information under false or fraudulent pretenses. These people or institutions who do this illegal act are known as pretenders. The Do Not Call Registry is a national list established by the Federal Trade Commission and the Federal Communications Commission, where telemarketers and sellers are required to search the registry once every 31 days and remove from their call lists any phone numbers of consumers who have registered themselves on the list. These records must be kept for 24 months. Now, while the National Do Not Call Registry does not limit calls by political organizations, charities, or telephone surveyors, it is important that you know that telemarketing calls may only take place between 8 a.m. and 9 p.m. in the time zone of the consumer who's being contacted. The Mortgage Assistance Relief Services Rule, otherwise known as the MARS Rule or Regulation O, is a rule that was established to help the prevention of foreclosure scams by distressed homeowners through the negotiation assisting borrowers with loan modifications. So I remember that the MARS rule has to do with distressed homeowners and creating loan modifications for them because the level of stress a borrower has when their home is approaching foreclosure is out of this world, just like the acronym MARS, because it's a planet out of this world. In addition to Mars being a planet, and planets are in the shape of circles, hence Regulation O. I know, it's a long way to get there, but hopefully it makes sense to you in the way that it made sense to me. Now, I really want to emphasize here that Mars deals with the prevention of foreclosure scams. So basically what used to happen is that distressed homeowners were desperate to have some form of relief when it came to their home. And it made them very susceptible to crooks that preyed on their desperation. So when they couldn't make their mortgage payments, these crooks would encourage borrowers not to communicate with their lenders, and they would collect fees without proper documentation or disclosure of a plan for how everything was going to get resolved, leaving the homeowners in an even worse off position than they were before. Now, because of the Mars rule, any mortgage assistance relief programs may not discourage borrowers from speaking to their lenders or charge upfront fees unless the mortgage assistance relief servicer delivers and the customer agrees to a written offer of mortgage relief from the customer's lender or servicer. They must also provide proper disclosure of the terms and clearly communicate them and not misrepresent the services they actually provide. Now, the Bank Secrecy Act and anti-money laundering law requires companies to file what's known as currency transaction reports with the IRS for any cash transactions that are over $10,000 in one day. These records track the withdrawal, deposit, or transfer of funds of $10,000 or more in one day. Now, because of these two acts, a mortgage loan officer is required to report any suspicious activity that comes in the form of tax evasion, money laundering, or any possible criminal activity that exceeds $5,000. The way that a loan officer reports suspicious activity is through what is known as a suspicious activity report, otherwise known as a SAR. A SAR must be filed within 30 days of first detection of suspicious activity if the perpetrator is identifiable, or if it's filed within 60 days of initial detection if the perpetrator cannot be identified. The SAR's reports must be kept for a minimum of 5 years. It's important that you familiarize yourself with examples of what constitutes suspicious activity, because questions like that will be identified on the test. It's also important that you understand that money laundering involves the transfer of funds into and out of a financial institution for the purpose of evading law enforcement. Often, laundered funds are linked to greater crimes, which include but are not limited to sex trafficking, drug trafficking, and terrorist crimes. Speaking of terrorist activities, this would be a great time to introduce to you the USA Patriot Act. Now, this was created not only to prohibit money laundering activities, but also the prevention of financing of terrorist activities. It's because of the USA Patriot Act that enables law enforcement to search telephone, email, medical, and financial records for possible money laundering and terrorist activities, while also making it a requirement for a mortgage applicant to provide their name, address, phone number, social security number, or tax ID number, in addition to a government-issued ID when applying for a mortgage. The USA Patriot Act also enforces that financial institutions verify the identity of their account holders and establish anti-money laundering protocols and train employees on this policy. Since the ever-evolving technology boom that we've experienced over the past few decades, the home buying process has been made even more seamless through the integration of e-signatures, also known as electronic signatures. And with any new tech evolution, there must be new rules, such as the e-Sign Act. The e-Sign Act allows for consumers to use electronic signatures as a valid and legal way to enter into contracts as long as they have consented to the use of electronic signatures and also have the software capabilities and knowledge to enable them to use electronic signatures. However, a consumer cannot be forced to use an electronic signature. They may choose to use a signature made with ink, which is known as a wet signature. And remember, two parties involved in a transaction do not have to use the same method of signing to make a contract valid. When I received my conventional loan for my mortgage in 2017, I didn't have a 20% down payment. Because of my lack of a 20% down payment, I received what's known as private mortgage insurance. Now, this type of insurance is an additional amount that I had to pay monthly in my mortgage payment towards my mortgage to protect the lender from the possibility of me defaulting on my loan. So even though I didn't have the 20% down on my home to avoid private mortgage insurance initially, I am able to request the cancellation of my private mortgage insurance when I do reach 20% equity in my home. It's because of the Homeowners Protection Act, also known as HIPAA, that I am entitled to request the cancellation of my private mortgage insurance when my loan to value equals 80%, meaning that I reach 20% equity. However, the lender can always choose to tell me, no, Andrea, we're not going to cancel your PMI. And that is their right. However, when I reach 78% loan to value, or you can think of it this way as 22% equity in my home, my private mortgage insurance must be canceled per HIPAA. It's important that you know that private mortgage insurance may be requested to be canceled at 80% loan to value, but must be canceled at 78% loan to value. The important things you need to know and understand about the Mortgage Acts and Practices, otherwise known as MAP or Regulation N, is that the CFPB enacted it to ensure that no false or misleading advertising of any mortgage products existed. Now, don't confuse this law with TILA because Regulation N specifically deals with commercial communication. So this could include, but is not limited to, radio, TV, social media, etc. Whereas TILA is specific to all advertisements, specifically as it relates to the disclosure of the APR. MAP specifically deals with misleading or false information, like the appearance of being a government-affiliated entity, for example. Any commercial communications must be kept for 2 years according to MAP. When we talk about the general mortgage knowledge portion of the SAFE exam,